What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. When this typically happens, it's not good for the markets. All that and more on today's Stock Market Brief Show. We got it time-stamped in the description below. If you're new here, well, welcome to the channel. Make sure to hit that thumbs up if you haven't done so already, and subscribe if you're not a subscriber. We do daily market analysis. In today's video, we're going to be going into the news. We got some stuff on the calendar for this week. We have weekly performance that we're going to talk about, expected moves, the JWAP. If you don't know what that is, well, you'll find out. Bonds and yields, commodities, and of course, some indicators as well, with the conclusion at the end. Let's get into it. Welcome back, everybody. In the news, we have Jeremy Grantham out talking about the super bubble and the stages within the bubble. Typically, stage 1 is where the bubble forms and stocks are soaring. Stage 2 is when you see a meaningful decline, and then we get a bear market rally. And that makes people believe that new highs are coming. But then that sets the stage for the final drop. He had mentioned, quoted in the article, the current event so far is looking eerily similar to these other historic super bubbles. And one of the couple of those periods in time mentioned was 1929, 1973, and even 2000, when the NASDAQ composite recovered 60% of its bear market losses from the tech bubble. What else is going on in the news? Consumers feel worse now than they did during the COVID lockdowns. During the COVID lockdowns, you can see we had a little bit of uptick on the consumer sentiment, but it's still remaining very, very low. The steady labor market keeps the Fed on track for another rate hike, reported by the Wall Street Journal. And the hopes for the Fed pivot, well, they're getting slapped in the face. You can see here is a chart from the Fed website. The blue line is the Fed balance sheet, and you can see when this soared like a rocket ship, so did the S&P 500 in red. Now you can start to see the tapering take place, and more tapering is going to continue into this year, and the stock market turbulence has picked up as we're seeing massive moves to the downside, as well as massive bear market rallies. This aggressive stance by the Fed has sent the yen to a 24-year low against the dollar. Meanwhile, the dollar is breaking above 110, hitting a 20-year high. Now, a strong dollar, when you see that surge, you have American buyers splurge on European homes. Go figure, right? Here's the Italian island of Capri, and one of the agents there had mentioned that they're starting to see a lot of clients from the Pacific Northwest and Midwest come. Meanwhile, in the United States, home sellers are cutting prices as the housing market cools, and you can see that in Redfin weekly data, looking at price drops. And you can see the black line right here. We're starting to see a big, large spike, not even coming up into, peak seasonality of this so far, looking back to 2019. That is the percentage of homes that have been on the market, and now you're seeing price drops. All right, what else? Well, this has people obviously wondering if the stock market's going to finish positive for the year. It's possible, but it's unlikely, and we're going to be talking about that in today's video. Calendar, what's on the calendar? Week ahead, we have central bank meetings in the Euro area, Australia, and Canada, as well as several speeches by Fed officials will dominate the calendar next week. Also, China will release inflation rate and foreign trade figures, and GDP updates will be available for Australia, Euro area, Japan, and Canada. Investors will also be watching closely the situation in the energy market in Europe after a crucial pipeline bringing gas to Germany from Russia will no longer reopen as planned. A lot of stuff taking place in the markets. If we take a look at tomorrow, what is that going to bring us? ISM non-manufacturing PMI. This is going to be slightly after the market open, 30 minutes into the market open. We have Australia, the GDP growth rate there too as well. Those are the bigger market events. As you can see, they're highlighted in red there. Let's take a look at week-to-date performance, the weekly recap here. All right, how did the 11 sectors in the S&P 500 finish in the 1 week performance? Well, everything was in the red. XLU healthcare led the way. So yes, based off of, what I'm seeing here, it's defensive posturing. And even in a defensive posturing environment, they can still go down. Utilities, consumer staples, healthcare, they can all get hit down, especially when you just start to see volatility rise, okay? But this right here is obviously still outperforming the S&P 500 from a relative standpoint. Okay, let's take a look at the heat map week-to-date performance. The big one that stands out here is NVIDIA was down 16% on the week. AMD, 12%. So semiconductors got massively hit. Tesla, auto manufacturer, here minus 6.21%. And you can see across the board, the big tech stocks, they did get hit, and they got hit hard. How did the S&P 500 do? It was down 3.29%. It's third consecutive week down in the red. And now I want you to pay attention to a couple of things here. There's a couple of things that I'm looking at if you're new here. First and foremost, look at the RSI on these next charts I'm going to show. I'm going to go fast. Okay, RSI, it's pointing down below 50. Okay, the next one is the PMO. It's below 0. Okay, that's that, and it's kind of curling itself back over. So we have wind at our face here, wind at our face. So if you're a bull, we got wind at our face, right? So we can see bounces, but we still got wind at our face on these weekly time frames. The next thing I want to call out here is the red line is the 40-week moving average. It is declining. Okay, which means what? We still got wind at our face. In order to be a bull market, we need to see something, it would take some time for this to start flattening out and for stocks to start getting above it. It could be a very long time before that happens. Okay, and then I want you to pay attention to this 5-period weekly moving average. What I'll point out right here, what you're going to notice, is almost every single chart that I'm about to show you has it hit it, and then it started reversing right from it, okay? So we're completely disconnected from the 5 EMA when the next week opens. It's a shortened trading week, so the possibility of reconnecting, the likelihood of that is going to grow if we stay disconnected from it for a while because it's a frequently tagged EMA. So that's the S&P 500. Here's the NASDAQ 100. You can see 5 EMA, declining 200, RSI, PMO, same situation goes. I'm not going to spend too much time because I got a lot of charts to go over. NASDAQ Composite. NASDAQ Composite is a huge index, right? RSI down, PMO down. Got the 5 EMA tagged, right? Declining. 40-week period moving average. Now, a big portion of the NASDAQ Composite is semiconductors. Semiconductors never tested its 40-week moving average, so it's showing more relative weakness here, and we have a bearish crossover taking place on the PMO below 0. RSI is pointing down, and you can see that we did tag that weekly 5 EMA, which is declining. So still bearish momentum. Things might be getting overextended to the downside, but remember, 1, breakdowns can happen, and then 2, when it rallies, it needs to be viewed with some pessimism given the current context of these charts. Let's look at Dow Jones Industrial Average. Tag that 5 EMA, tag the 40-week moving average, RSI, PMO, both wind at our face. Transport's another big thing to watch out for, especially in line with the Dow Jones. Okay, we're below that 40-week moving average. It's starting to slowly curl over. This to me looks like just a monster area of distribution where you can see price get much more volatile, right? We had a nice big run up, a markup. Stage 3 is distribution. Perhaps we're going into a stage 4 decline, and we haven't seen, much of that yet. RSI's down, PMO's down, and obviously the 5 EMA2 as well is pointing down too as well. Let's look at IWM, so small caps. Clearly in a downtrend, looking at the 40-week moving average. 5 on a more shorter term period, 5 EMA pointing down. PMO is curling over. It's below 0. RSI below 50. Got wind at our face. Okay, let's look at biotech. Biotech put in a indecision type candle. Yes, it was down 1.43% on the week. All right, we have the PMO. It's not, it's flattening out, but it is still below 0, and RSI is below 52 as well. But this right here shows us we have a strong authoritative candle given the context of the body of the candle. And you can see here we have a smaller candle which could lend to a pause or a period of consolidation before we see some stronger movements. It also can potentially mark reversals, so we'll see here if we get some sort of a bounce in IBB. But under 120, right here in this area where we had prior support, turned into prior resistance, turned into prior support, and we're back at that level. So if we start getting below that and have a weekly close below it, it could spell out trouble, even for them biotechs that have been showing some decent relative strength. SOCL. I haven't shared this one, but I'll share it now. This looks just completely hammered. This is the Global X Social Media Index ETF. And as you can see here, social media names, you can look at the holdings or what are in this if you'd like. Completely falling flat on its face. Very bearish context, been bearish for quite some time, and it looks like it's just on the cusp to break down even further. Okay, so be very careful here. I will call out that, we are starting to see positive divergences form. It's just in horrible context overall, though. Then we have the ARK fund to talk about, down 5.25% on the week, breaking down obviously from this bear flag, still in bearish context and a stage 4 decline, right? We had a nice big markup, stage 2. Stage 3 goes into distribution where you see those wild swings back and forth. And just when you think that, hey, it can't go down any lower, it sure as heck does, just like we started to see this recovery, and still no signs of actually accumulation or that it's basing out here at this particular time. Still looks very weak. week. It's trading under the 5-week moving average, and obviously it's declining 200-day. RSI is well below the 50. Actually, never really even got close to crossing back above since really November of last year. So overall, profitless tech, go figure, it is not looking too hot. Now it's time to look at our expected moves. What are expected moves? Well, it's what the options market is pricing as far as future volatility. Gives us an idea of where price can go within a trading week. They are weekly expected moves. This was last week, and last week was producing about $100 expected move here. And you can see the lines on the screen. That is based off of the implied volatility. It's a calculation that we're pulling from Thinkorswim platform. We closed outside of the weekly expected move for the second week in a row. Last week was a 2 sigma move breaking down out of it. This week we closed just right at it, but it was under. Now it's very rare to have 3 weeks in a row of cracking and closing outside of the weekly expected move. Now next week, what does the weekly expected move look like? The next week is right here. The expected move is plus or minus $94 approximately. And keep in mind, we only have 4 trading days. So the volatility here is not chilling out. This is still a massive amount of volatility in a short period of time. And when you look back at the last 2 weeks expected moves, they were very large, and we more than doubled it on one of the weeks. So volatility is still here. We can still see surprises, but like I said, it is rare to see 3 in a row closes outside of the weekly expected move. So what are these levels? The low end right here is 38.30. The high end right over here is 48.18 on the SPX, the S&P 500. If we take a look at the SPY, we are still below a declining 5-period moving average. We were talking about a bounce on the prior episode. We got that bounce, and then we fell right back down. That is what I've been saying. You gotta dodge, duck, dive, dip, and dodge this crazy, crazy market. Now, in order to feel more confident from a bullish perspective on a time frame like this, we want to see price trading back above a 5-day moving average. But not just above it, it has to start flattening out to going neutral and then start to turn positive. So it could take some time to do so. But as it stands right now, price came above it once, came above it again. But guess what the 5-day moving average was doing? It was still declining, giving us a warning sign to be very careful. Okay, let's take a look at the Qs. The Qs, last week expected move, quite large. We closed outside of it. Not going to dig too much into that. This week, right over here on the Qs, we're looking at 304 right over here and some change, 304.55 if I'm being exact. And below us, the level is going to be 285.79 on the low end. Now, what is interesting about the Qs right here, as many tech stocks have been getting pretty overextended to the downside. Now, keep in mind, distribution days are piling up. I see about 5 of them right there when I quickly look. There is a gap fill right down over here. There is the weekly expected move right down here. So this zone right in here can potentially act as a bounce level, especially if we get a strong move to the downside. I'd be prepared to potentially play a bounce play coming back inside the weekly expected move, similar to what I did last week when I talked about the IWM and I talked about GDX. Let's take a look at the Qs on the 65-minute time frame here. We're looking at a 30-period moving average, which ends up being about the 5-day moving average. 5-period moving average is still declining. Price got about it once, got above it twice, but the 5-period moving average was still declining, which we need to be careful, right? Be patient. If we saw this big move out of the gates, probably FOMO'd a lot of people. If you weren't paying attention to a declining 5-day moving average, amongst other indicators that were out there, you may have gotten caught off guard. But we came up, we came back down. We're trading right around that low. We got to see this neutralize. Maybe it might look something like this. Boom, boom, boom. Starts to neutralize itself out. And then, hey, yay, we can go into another markup phase. It's not there yet, so be patient. IWM closed outside of its also weekly expected move. If we take a look at next week, what do we got? We have just above 185 on the high end, 185.45, and 174.73 to the downside, which lines up with prior areas of resistance and prior areas of support right there. So we'll be just very aware if price were to come down into these levels, or even if so, we start moving back up. We're below some key moving averages, okay? And then also right here at 185, that also lines up with this volume profile over here, which can potentially act like a magnet in some cases, okay? So if we take a look at the 65-minute time frame, We're still below that declining 5-day moving average, right? We got above it. It was still declining. We almost got above it. It was still declining, and it was rejected multiple times. This is one that I actually traded the wedge, and then we popped up to the upside. And just about when we got to last week's weekly expected move is when I closed the majority of that position and put a stop to break even. Then I got stopped out on the remainder portion on this move down. So it's all about being tactical, as previously stated. Let's look at the Jerome weighted average prices. Jerome weighted average price, what does that even mean? It's an anchored VWAP on every single time Jerome Powell talks. Why? Well, markets listen to what he says. When he says something like he did over here at the Jackson Hole Symposium, it ignited a market move to the downside. So I want to see where the average weighted volume is trading anchored to the days that he talks. Originally, we talked about the JWAP zone. The JWAP zone was taking all of those levels here, and you could see how price doodled around and then finally blew up to the upside. This is the SPY. And now we came into the JWAP zone. Now, what's interesting here is if you take a look at the previous trading day, we saw a monster gap up, which got a lot of people excited, but it came right into the level which we were discussing, the Jerome weighted average price, then rejecting itself back down to that 390, which was another key level to be well aware of. If we start breaking down from 390, remember, we're trading now under all those anchored VWAPs, which are acting and has acted as prior areas of resistance as support. So the longer we trade down there and it acts as resistance, it could further send us more to the downside, potentially coming into the 370 area, okay? If you want to be more bullish in this case, you want to see price get right back above the anchored VWAPs here, okay? If we take a look at the Qs, same situation, came right into the Jackson Hole speech anchored VWAP level, and it got rejected. If we take a look at the IWM, this one is closing slightly below all the JWAPs there, and it didn't quite come retest this level. But once again, in order to be more bullish, we need to be above one, a 5-day moving average, and it needs to be inclining. And two, we want to get back above those anchored VWAP levels. It's as simple as that, people. HYG, I'm showing you this one because this one actually gave some insight early on. The Jackson Hole came out, right? We anchored it to there, and this one closed below the JWAP zone, potentially giving us insight because bonds are, smarter money. And it closed outside of the JWAP zone, indicating that, hey, maybe the indices will follow shortly thereafter. And you can see here, boom, this, when the SPY at Jackson Hole, it didn't close, it closed above, and now we're starting to close below those JWAP zones. So interestingly enough, picked up, just wanted to share. Let's take a look at bonds and yields. I'm going to first show you HYG up top, SPY down beneath us. Think of this as smart money, and this is dumb money. This is just an easy way to interpret it. It doesn't mean that the SPY is holding dumb money. A lot of smart traders trade it, but the bond market is considered the smart money. Now, what I point out here on this hourly time frame is when I see divergences. They typically move hand in hand, but when I see divergences take place, I want to call them out because they could mark potential turning points in the market. So when the HYG, the smarter money, when the market's moving down, but yet you can see the HYG puts in a higher low relative to the S&P 500, putting in a lower low, the market is telling us the smart money might be seeing the market move up, and bam, we saw moves to the downside. On the flip side of that, if you see smart money put in a lower high and the S&P 500 is putting in a higher high, that then has been called out where we can see potential moves, follow-throughs to the downside in the market, giving us a heads-up notice. That recently happened over here when we called it out on Twitter and on this video. That was the start of that big move to the downside after that bear market rally in the S&P 500. The reason why I'm calling it out now is the HYG is currently putting in a higher low, and the S&P 500 is really having a matching low right here. So it's a very early to tell. So what you want to, if this is actually going to play out, it would be much better to see HYG back above 75, and even the S&P 500 to even move a little bit lower right around this range, or just doodle around here. If that is the case, and HYG breaks out of 75 and SPY hasn't done it yet, that could be an early indication that we might see a pop to the upside. I don't know how high it's going to go in the S&P 500, okay? And I'll let you know if I see that take place. Meanwhile, let's take a look at bonds and yields. The curve, pay attention, it's starting to curl right back up. It's still massively inverted, 20 basis points. And then the 10 and 3 is still not inverted, but it's flatter than a pancake. You can see here just the yields continue to just kind of move higher and higher. So we'll see what takes place there. Now, this was the thumbnail, so let me get into it, right? Every time this happens, it's not really good for markets. What am I talking about? I'm talking about when the 10-year and 2-year curve uninverts, right? So it comes into deep inversion, boom, boom, boom. This is a monthly time frame, and we're looking at, in the 89 coming into the early 90s. Remember in 1991, I believe it was, or the early 1990s, there was a stock market crash, dot-com bust, and then the great financial crisis here too as well. Now pay attention. I marked these pink vertical lines going down through the screen, and it shows you when it uninverts, when it uninverts, when it inverts. So when you get the inversion, it gives you a heads up notice that there could be very well a recession just around the corner. And when it uninverted, I wanted to call out here, the market fell 51%. The market fell 58% there in the great financial crisis. As it stands right now, the market, in terms of overlooking all of this, the market hasn't really fell all too hard at all. It's been quite volatile, but it's been overly kind of orderly. All right, it hasn't been some crazy crash. There hasn't been some systematic damage that has taken place. There are a lot of things very bearish to call out, but overall the price action, when given everything that's taken place, is holding up decent for the most part, okay? However, we do see a little bit of an uptick in that curve, which is why I'm pointing it out right now on these lower time frames, daily time frame, 10-year and 2-year. You can start to see it pointing back up. Not saying that it's going to, but history does suggest that when it starts uninverting, we can see continued stock market turbulence, right? Boom, boom to the downside. Now, what would that look like if we saw another 58 or 51%, great crisis? Well, that can bring us down to around 2,500, which is around the COVID low in the S&P 500. And no, I'm not predicting that to happen. I'm just giving rough estimates here of what we've seen. And then the even steeper one, if it were to come back test, which would be just, that'd be crazy, is like around 1,600, 1,500 range. I'll get those accurate numbers more specifically, or you can pull up a chart yourself and look. But that would be, right here, it would be an insane buying opportunity if that were to actually take place, in my opinion. But we're not there, just showing you the charts. Let's take a look at TNX. TNX backed off slightly on Friday, but it was up on the week there, is down 2.21%. So this continues to move upside. Just bond markets are hard to follow. So if we start to see this down tick a little bit more, that might ease off of tech a little bit. And also we might see bonds bounce a little bit. What do I mean by tech? I mean from a relative standpoint, right? If you take a look at the 10-year yield on a weekly time frame, it goes down right here. And then the relative performance, XLK to SPY, that means when this goes up, technology is performing better than the overall market. That goes down, that happens. But when this goes up, that happens. Okay, so if this were to start coming down or taking a little bit of a breather, perhaps this levels out. Maybe it bounces a little bit, right? We're getting some overextended areas to the downside. So there's going to probably be more bear market rallies that take place. So we'll continue to monitor that and see just what develops. If we take a look at TLT, saw a little bit of a pop on the day, but nothing too much, up a half a point, and we're just back here trying to test this prior area of support, which could act potentially as a double bottom, right? But a double bottom wouldn't be considered a double bottom up until we actually crack above this high right here, which is just above 120. So right now we're just in a sideways channel, but in a shorter time period, we're looking just in a down channel right now too as well, okay? Let's take a look at some commodities. Commodities, the CRB index forming a bear flag, closed below the weekly 5 EMA. RSI is pointing down, PPO is pointing down. Doesn't look all too healthy right now for commodities. So if this plays out to the downside, what you're going to see here, commodities peak, right? We flag, we break back down, probably can come to around I'd say 260 would be right here where this candle is, and then we can come even to 240 down in this range if commodities continue to just back off, and then the inflation rate obviously comes down slowly but surely. Still, it's a little sticky. If we look at Dr. Copper, we talked about this being a good short opportunity right here on this candle. So if you caught it, bam, 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 to the downside, not too shabby. I played myself, ticker symbol FCX, which is one that I share with the Patreon community. But I want to point this out now. We do have an indecision candle. So what we have here on the right-hand side of the screen is we have authoritative, right? Big, strong red candle, big, strong, big, strong, big, strong. And now the body is getting a lot tinier, indicating that this could be either a pause or a bounce area. Doesn't necessarily need to mean that, but it's showing that the momentum here based off of the body has slowed down, where it was up very slightly on the week. If you take a look at gold, Gold was a nice little pop to the upside, right? We have a somewhat of a positive divergence that was building. If we can undercut this low, that'd be nice. Up 0.78% on the trading day, but we've been getting hit pretty hard overall. But when you really step back and look at it, this black line across the screen is year to date, right? So it's down, what, 5%, 6% year to date versus some other assets. And yes, this is on the back of a very strong rising dollar, which we just recently discussed. Silver did undercut this low over here, and we saw a little bit of a pop on this positive divergence. This to me looks like a potential opportunity as we've been getting pretty hit hard to the downside. Now the thing with silver is it moves hand in hand with the miners. This is something that I pointed out. I'm out of my position because I took a leveraged trade on ticker symbol JNUG, and it was up 10% on the day, and I'm not going to give back those gains if I'm wrong about a pop here to continue. Okay, so I'll trade around the position, but the correlation between miners, GDX, which is in a bearish trend, but you can be tactical. It's in a bearish trend, and the correlation is literally almost a 1-for-1 on a 20-period basis. And you can see the gray is silver and the brown here is the GDX miners, and they literally just move hand in hand together. So if silver starts to pop up higher, I'd expect to see the GDX continue, but be mindful of the overall trend. It still remains down. Now let's get into Saylor's Schiff tool. Saylor's Schiff tool is still on a sell signal, an active sell signal since this week over here. And we're starting to see some weakness move down. So there could be very well some more downside in the price of Bitcoin. We need to see it to be more bullish. We need to see it get back above the 0 line right here. If you're wondering what this is, I do have a link in the description that walks through how to build this indicator and how I use it in a trading strategy for crypto and crypto related assets. If you take a look at Bitcoin here, it looks anemic. To be honest, it looks like it's going to start breaking down here unless if something magical happens. But it's down 1.46%. That's right now on this current trading day, which I'm recording on Monday. But it just overall, like, it's just moving sideways. It's like it's walking a plank. Like, hey, here's a ship, right? Here's a ship, boom, and they have a plank right here, and you got, Bitcoin is this guy, and he's just being forced off, with a sword being forced off to jump into the depths of the ocean here is what it looks like, to be honest. So we'll continue to monitor, see what happens here. If you take a look at Ethereum, looks a little bit stronger, but it's below these key moving averages. It's kind of wedging itself up. Also not looking all too hot right now, so it needs to get back above that 1750. If it can do that, I think we can go retest this prior high over here at about 2000. So we'll see if we can get some sort of good movement there. Let's hop into some indicators now. First and foremost, I want to look at some safety ratios. We talked about gold. Now let's look at gold relative to the S&P 500. It's getting above the 50 period EMA for the first time really since July of this year. Okay, so this right here could be an early indication that we might start to see some relative strength continue to pick up in gold, which is more of a safety type, known as a safety type trade. Utilities has been on a monster tear on a relative standpoint. Yes, we already talked about relative standpoint still means it can go up. But remember, if the VIX VIX volatility index starts to fire up to the upside, all these can get hit from an absolute perspective, but they typically perform better from a relative standpoint. And just so you know, utilities hitting a new relative high, that's not necessarily good for the market. This is a defensive sector. So when you start to see a defensive sector put in new relative highs, not that great for the overall market. If you look at consumer staples, it's above that 50 period EMA, but it's rather neutral to flat. TLT, it's trying to get back above that 50 period moving average, TLT relative to the S&P 500. If it starts doing that, perhaps bonds might once again act as a safety trade, but it's just not happening so far. If we take a look at defensive sector, it's rather flat overall from a relative standpoint, but it is, right there to a neutral above a 50 period moving average. And then healthcare too as well came into the 50 period moving average, not as strong from a relative standpoint as the other sectors. And you can see it's kind of rejecting itself slightly off there. So if we can get back above it, start seeing some strength here, that'd be better. But this one is declining as it stands right now. Let's take a look at the old fool indicator. The old fool indicator helps us identify trends, and we're utilizing the NASDAQ composite, dividing it into the CPC, which is the put to call ratio. In simple terms, I put a couple period moving averages on it. This is something from the old fool. When the green line crosses below the blue line, could indicate some weakness in a trend. And it didn't change up until this point over here where we started to see a move up higher. The reason why I'm pointing it out now is obviously we're seeing this crossover again take place, which could indicate that even if this bounces and this stays under, the trend could still obviously remain more pressure to the downside. So remember this from a trend perspective. Now, if you look at the put to call ratio by itself, the buy signal is when it crosses down through the green line. We're pretty far off as it stands, so the market can rally if it starts turning back over. That means the purple line has to come down too, but we're pretty far off from a buy signal as it stands right now. The buy signals are the ones highlighted on the screen in green. You can see we had a buy signal, buy signal, buy signal, buy signal, buy signal. A sell signal occurs when the black line, the 10-period moving average of the put to call ratio, crosses down through the red line and then crosses back up through it. So when the cross back up through it, that is a sell signal, and that actually happened right before the market actually started seeing all of this turbulence into this year. A couple of other things from a trend perspective. Summation index, parabolic SAR is still beneath it, getting some momentum as we're forcing more to the downside, and it is crossing down through zero for the Nasdaq McClellan summation index, which is not a good sign. I will note that the McClellan oscillator is still in oversold conditions here. You know, it's been multiple days, so we're getting some pretty negative breath. These can act as areas where we start seeing bounces, okay? So just be aware of that, but it's also where breakdowns occur, which we've seen in the pandemic. The NYSE summation index, so we're looking at a broader market, still above zero, but this thing is pointing straight down, and we're still below 300. Remember, if we cross down through this and we're below 300, it has not been a good sign for the markets. And how do I know that? Well, we can highlight them via blue lines. When the summation index crosses down through zero and we get a negative 300 print on the NYSE McClellan oscillator, this, you can see here, we saw some turbulence, or went sideways, then we got it again, went down pretty hard, and then right here too as well in the pandemic went down hard, and even going into 2022 we started seeing it, and then we started going down pretty hard. So we'll be watching that very closely. If we take a look at volatility indexes such as the NASDAQ volatility index closed at 3232. It's in the 30s, people. It's in the 30s, okay? This is not where you try to be all, heroic. This is where you back off a little bit and be careful. Remember what I said prior to this episode. If you're familiar with trading it at, say, 15, and I use the VIX for example, if you trade a 100K account, and you're used to it trading around 15, and all of a sudden it goes to 32, you now have increased volatility. So it's like you're trading a 200K account, but it's still a 100K account. You just get more wilder swings, but that's just the volatility upticking. So you need a volatility adjusted trading system. If you're not adjusting your position sizing given the volatility, guess what? It's going to be a very hard thing to really handle given the current complexity of this volatility that's taking place in the market. If you take a look at VIX, it closed at 25.47. Be careful. That's the just where you're going to get whipped up. Same here with the Russell volatility. It's at 29.98. So we're going to call that 30. So be very careful there. If you take a look at growth over value, still below the zero line. Like I said, I would like to see it cross up through zero to feel a little bit more comfortable going long, maybe adding a little bit more size. But there's a couple other figures that we talked about, right? I want it above the JWAP levels. I want it above the 5DMA, and I want it to be flattened to start to go up, and then I want this to go up. That would make me feel a lot more comfortable going long or putting more positions, larger position sizes at risk. It's not there yet. If we take a look at BPNDX, 27.5, so it's still in pretty burnt up territory here. This is where bounces can occur, so be aware of that. No, don't want to get your face ripped off. And remember, it could be simply a big gap up, chase people's up, and then it dumps on you right away that same day. It could be a multi-day rally. Okay, it could be all kinds of things. Friday was a prime example of why you have to be very tactical. BPSPX chart 29.98 reading in the RSI is getting in that oversold condition. BPCOMPQ is pulling in 31.40. It's still not there yet, but it looks like it'll probably get there fairly soon. And then let's take a look at a couple of the sectors. Discretionary, one of the bigger sectors, still in oversold conditions. And on top of that, if we take a look at the tech sector, it's also still burnt to a crisp, 23.79. So let's conclude. What does all of this mean? Conclusion time, people. Conclusion time. So as it stands right now, when you step back from this marketplace, this is what I'm seeing, okay? And this is how I'm going about it. In order to be more bullish, first and foremost, to be safe, you don't want to pick a bottom. it's horrible. If you're trying to pick bottoms, you can get lucky once, but it's false hope right there, because you can if you try to pick bottoms long enough, you're going to be wrong and you can get destroyed. Okay, so as it stands right now, what would I personally like to see? And we'll use the S&P 500 as an example in order to feel more confident to go long. And then what are some levels to the downside? Okay, so we'll wrap this up. The main thing here is I want to see price back above the Jerome weighted average prices. Okay, that means we have to get back above 400, a closing day above 400 to feel a little bit more confident. That's one. Okay, the next one is I want to see the 5-day moving average. I want price above it. I want this to neutralize, to start pointing up, because as it stands right now, you have a trend that is against you from a long period. What do I mean long period? I mean the daily, lower highs, lower lows, and then also the weekly. So you have lower highs and lower lows here too. Wind is at your face. The trend is down from all aspects right here. So as we have markets and various equities, like we stated, very overextended to the downside. And what do I mean by that? Like, you can look at the heat map, right? We're getting hit hard. They can get hit harder. But we're starting to see the BP charts and indicators suggest to us that we could very well easily rally too. So this right now is a very, very complex situation. So I'm looking to potentially play long tactically, okay, from overextended areas, meaning I am fading a move to the downside to play a short technical bounce from a good risk to reward perspective. But then I'll be looking, as if price comes up, to declining moving averages, to declining areas, to overhead resistance, to volume shelf profiles, whatever the case may be. I'm looking to reshort into weakness, okay? That is what I'm looking to do going into this week. It's a shortened trading week, okay? So be careful out there. Volatility, it's still high, it's elevated. Can't say that enough. It is just not looking good, okay? And when it does, we'll talk about it. But as it stands right now, hope you're all enjoying your extended holiday weekend. Goodbye.